I lost $85,000 over 4 years trying to become a trader. And the crazy part was, I knew what I was doing the whole time. I understood price action and market structure. I knew how to read the market and how to trade it. I even had some solid win streaks and some payouts, but nothing stuck. I'd end up blowing everything I just made, and I couldn't figure out what was wrong with my strategy or how to fix it. Then I realized something. It wasn't a strategy problem, it was a structure problem. I had no rules, no limits, no framework to protect me from myself. I expected perfection every day. But when emotions kicked in, like when a trade went against me, I had no plan for that part. I'd size up when I felt confident and revenge trade after a loss, or stay glued to the screen all day trying to make something happen. And I'd tell myself, I'm following my strategy. But I wasn't following anything. I was gambling with extra steps. And of course, it drained me both financially and mentally. I had a strategy, but I didn't have structure in place for that strategy to actually grow. If I had just been handed a simple set of rules from the start, not a strategy, not indicators, just a framework, I could have avoided years of unnecessary losses. Honestly, I could have done it in 6 months with less than $1,000. So in this video, I'm giving you the shortcut that I wish I had from day one to dramatically accelerate the process to consistent 5-figure months. Let's begin. Here's the thing. It's not about skill. It's not about reading the market perfectly. It's not even about being right more often than you're wrong. Because plenty of smart traders still blow up. They can chart every setup, call every level, and still lose everything. Because they can't follow their own rules when it matters most. They can talk like professionals, but they trade like addicts. And that was me for years. I could read the market just fine, but I just couldn't control myself enough to profit from it consistently. Because what ruined me wasn't the occasional bad trade or mistake. Every trader at every level makes mistakes and has bad days. But what crushed me was the extra trades outside of that. The boredom trades, the revenge trades, the overtrading. The kind of trades I'd look at later and wonder, what the hell was I thinking? Because look, if you follow a system consistently the way you're supposed to, you can expect a certain range of results. Let's say you had average execution for the week. Well, you can expect a certain P&L. Now, if you had great execution for the week, with sharper entries and excellent analysis, then you can expect a higher P&L. And if your execution wasn't so great, then you can expect a lower P&L. That'll usually be a late entry, a few mistakes, or maybe just a missed trade altogether. This is what you can expect. It's somewhat predictable, right? Your system will present certain setups, and depending on how well you execute those setups, you'll end up with a P&L in this range. This is something you can easily work on and improve on, and also scale. But the problem is this. When you start introducing trades outside of the system, then it becomes completely unpredictable, and usually not for the better. Either way, it's definitely not a reliable way to build a P&L at all. So what I did instead is create a set of rules, simple ones that would protect me from myself. Rules that basically forced consistency and didn't care about my emotions. And that's when things finally started to work. My account stopped violently swinging up and then more violently swinging down. My equity chart looked more like a set of stairs than anything. I was following a process and risk structure that removed me from the equation as much as possible. And that's what every consistently profitable trader has in common. Not talent, not luck, just structure. So let me show you exactly what that looks like. Here are the 4 rules that made me profitable. Rule number 1, the profit lock rule. So here's the truth. The more you expose yourself to the market, the higher your chances of losing. More screen time doesn't equal more profit. It's the opposite, actually. Looking at price action is hypnotic, and looking at it too long will make you see things that aren't really there. Every trader can go into the day saying that they'll be patient and wait for the setup. But remember, discipline is a finite resource. After a few hours of watching the price move without you, your discipline starts to fade. And before you know it, you'll enter a random trade just to feel like you're doing something. The more your discipline breaks, the more you'll keep breaking it. And the easier it becomes to break. Eventually, you'll find yourself overtrading, revenge trading, tilting, and other things that you thought only beginners do. And we don't want to get into that cycle. So now, I keep it brutally simple with the profit lock rule. If my first trade is a win, then I'm done trading for the day. That's it. Screen's off, and I walk away. That first win puts me in profit for the day. not just financially, but psychologically. I've proven my edge worked, and I've executed cleanly. That's all I need. In this case, using the LCE model, that would mean one successful level-to-level trade. We enter at one level, then hold and exit at the next one. Actually, I'll link a video right now where I go more in depth on exactly how to trade the LCE model that you can watch later. But I'm looking for one high-quality level-to-level move every day. Now you might ask, but what if there's more than one good move a day? And the answer is, sure, there might be. But it doesn't happen often enough to be worth trading. On trend days, we might get 3 or more level-to-level moves. But trend days are not super common. They happen maybe 15 to 20% of the time. The rest of the time, it may do only 1 or 2 level-to-level moves, then stall or reverse. The market is not predictable at all in that way. And the longer you sit there, the higher the odds that one small mistake unravels everything you did right earlier. We're just looking to nail 5 to 10 quality A-plus setups a month, and there are 20 trading days a month, so catching one good trade in a day is more than enough. Anything more should be considered a bonus and should definitely not be forced. If I catch that, I'm out. I lock the profit, protect the mental capital, and preserve my edge for tomorrow. We want to slowly stair-step our way to profitability and use that to scale much higher. So that's why I lock in profit the moment I get it. Now, of course, not every day is a win. Some days that first trade doesn't go your way, and that's fine. That's part of the game, because this is where most traders self-destruct. They take a small red, feel that sting, and immediately start hunting for a makeup trade, and then another, and another. And it's the fastest way to turn a controlled -1 day into a full account blowout. So, rule number 1 protects your profits, and rule number 2 protects you, and rule number 2 is the 2-strike rule. This is how we manage risk and prevent any one day from setting us back severely. It's that moment right after a loss when logic disappears, and you convince yourself you can get it back. We've all been there. You take a red trade, maybe it wasn't even that bad, and you immediately start scanning for another entry. You tell yourself, I'll get it back on the next one. You start justifying things you wouldn't normally touch. You stop thinking about structure. You stop looking at bias. You stop managing risk. And suddenly, you're trading from emotion, not process. That's tilt. And it's brutal because it doesn't just cost you money. It costs you control. I can't tell you how many times I'd start the day down a few $100s thinking, all right, no big deal. But the moment I tried to force my way back to break even, everything fell apart. If I just stuck with my original plan, I'd be in a much better position. Within an hour, that small loss had turned into my worst day of the month. Not because the setup changed, not because the market shifted, but because I did. The second I started trading from emotion, I lost my edge. So I had to put a system in place that protected me from myself. And that's where the 2-strike rule came in. It's simple. I get 2 trades per day and that's it. If both of them hit stop, I walk away. No negotiation. No, one more setup. No, let me just try to get back to even. 2 losses and I'm done. Now that might sound strict, but there's a reason for it. If we get one level-to-level trade wrong, that's fine. It happens. If we take a second one and get that wrong too, then we basically misread the whole day, because most days only offer 1 or 2 level-to-level moves. So chances are, after 2 losses, there won't be any new opportunities to make it back. Even if you get a few wins this way, the risk of getting into even more drawdown and getting blown out on a single day is much higher. So we want to keep our max loss at -2R for the day, at most. So now we have the profit lock rule, which will secure us 1 win for the day at 1.5 to 2R usually. And we have the 2-strike rule, which will protect us from tilt and massive drawdown. Now we're turning our unpredictable and unscalable P&L into something that's way more predictable and way more scalable. And in trading, repeatability and scalability are the most important factors by far. That's how you literally 100x your return in a short time frame. And that brings us to rule number 3, which is to risk the same size for every trade. Now that we've got our wins protected and our losses controlled, we need to make sure every trade carries the same weight. Because this is where so many traders quietly destroy themselves, not by being wrong, but by being inconsistent. They lose because they size up when they feel confident, and size down when they're scared. They think they're being smart by thinking, this setup looks perfect, I'll double my size. But what they're really doing is giving randomness control over their results. And that's the vicious cycle. You start trading your emotions instead of your plan. The chart becomes a scoreboard instead of a system. You can't build consistency when your risk keeps changing every time your mood does. So I stopped doing that completely. Every single trade I take now, whether it's a textbook setup or just a decent opportunity, carries the same risk. Because once I standardized my risk, everything started to make sense. It made my data meaningful. It made my emotions neutral, and it made my results predictable. When you risk the same amount on every trade, you start to actually see your edge clearly. You know exactly what your average win looks like, what your average drawdown is, what your strike rate needs to be. You take all the mystery out of trading, and that scales beautifully. If you're consistent with $100, that same system will work with 1,000, 10,000, and more. The only thing that changes is the position size, not the process. That's what makes this rule so powerful. It's what allows traders to scale up fast without reinventing the wheel. And that's how you start thinking like a professional instead of a gambler. Because professionals don't bet more when they feel good. They risk the same amount every single time and let the edge handle the rest. That brings us to our fourth rule, which is to accept every single outcome, also known as the detachment rule. This one took me the longest to learn, because deep down, every trader, including me, wants control. We want to believe that if we do everything right, we deserve a good result. That if we analyze properly, if we wait patiently, if we follow all the rules, the market should reward us. But that's not how this game works. The market doesn't care how good your setup looks. It doesn't care how hard you've studied or how badly you want to win. Sometimes you'll do everything right and still take a loss. And that's normal. What separates consistent traders from losing ones isn't how often they win. It's how they respond when they don't. All of my trades end in three ways. It will either hit my stop, hit my target, or hit break even. And that's it. I only move my stop to break even once my trade is about halfway to its target. That's when I turn it into a free trade because it has enough space to breathe and hit target. I also know that if it dropped back below my entry from that point, it's probably not going to run back to the target, and it'll hit my stop instead. So break even is a clever maneuver when used properly that will stop that. So once I'm in the trade, I accept that it'll give me one of these three outcomes. I don't touch or adjust it after that, because the moment you start adjusting out of fear, you've already lost the battle mentally. Trading is about accepting uncertainty, not avoiding it. And that's what this rule is all about. Learning to detach from outcomes you can't control. The market doesn't reward people who need to win. It rewards people who can sit through uncertainty without interfering. If you've done your job, if you've respected your risk, followed your structure, and executed with discipline, then the outcome doesn't matter in the short term. Because over hundreds of trades, the probabilities will always take care of you. That's the detachment rule. It's about understanding that your job ends at execution, not outcome. You can't control whether a trade hits target or stop, but you can control whether you followed your system to the letter. And the funny thing is, when you truly stop trying to control the results, your results actually get better. Your entries get cleaner. Your exits get calmer. You stop cutting winners early. You stop moving stops impulsively. And your data starts to finally reflect your edge accurately. So when a trade hits stop, I don't get emotional. When it hits target, I don't get excited. Because both are just data points inside the same system. And that's the biggest mental unlock I ever had. Realizing that the goal isn't to win every trade. It's to execute every trade flawlessly, win or lose. Once I started trading with that level of detachment, everything else became easier. The ups and downs flattened out. My confidence stopped depending on my P&L. And I finally reached that point every trader chases. Consistency that actually feels peaceful. So when you put all four rules together, the profit lock rule, the two-strike rule, fixed position sizing, and the detachment rule, you start to see what real consistency actually looks like. It's not built on some secret setup or a perfect read of the market. It's built on structure. It's built on removing emotion and replacing it with process. The profit lock rule keeps your wins safe and protects your confidence. The two-strike rule stops tilt before it starts and keeps you in the game long enough to play the long-term probabilities. Fixed position sizing removes emotional volatility and keeps your data clean so you can actually measure your edge. And the detachment rule frees you from trying to control outcomes, so you can focus entirely on execution. Those four together are what turn a chaotic, inconsistent trader into a disciplined, scalable one. They give you something most traders never experience: emotional stability. Because consistency isn't just about profit, it's about peace. Once you stop fighting the market, stop chasing every move, and start operating within a structure, everything slows down. You're not trying to make something happen. You're waiting for your system to do the work for you. That's how you build the kind of trading career that actually lasts. That's how I went from losing $85,000 in 4 years to building a system that now pays me 5 figures consistently, month after month, without the emotional chaos that used to destroy me. And if you want to shorten that learning curve and actually build this kind of structure for yourself, I've built a mentorship around exactly that. The same process, the same framework, step by step. If you're ready to finally simplify your trading and start executing with discipline, the link's in the description. And if this video helped, be sure to leave a like and subscribe, because I drop videos like this every week. See you in the next one.